Over the past year, more than $600 billion of foreign money has flooded into US stocks. That's the largest inflow ever, bigger than at the peak of the .com hype, and even larger than 2021's stock market frenzy. That sounds like a vote of confidence, but when we overlay this chart with the stock market, we can see that massive inflow surges, like in 2001, 2007, and 2021, coincided almost perfectly with major market tops. In each case, capital rushed in after long rallies, not before them, and shortly after, markets rolled over. Now, this usually happens because of something economists call the crowding effect. Late in a bull market, strong performance feeds on itself. Strong returns attract more investors push prices higher, and higher prices pull in even more capital. But eventually, the market gets too crowded. When everyone who wants to buy is already in, there's no one left to keep the rally going. Optimism is at a record high, but fresh demand is empty. But if the market really is that crowded, we should see it in the data. This chart shows us how individual investors are allocating their portfolios, and right now, more than 70% of their assets are invested in stocks, one of the highest readings of the past decade. At the same time, cash levels have fallen to just 14%, near their lowest point in years. This means that the average investor isn't just already tapped out, there is almost no dry powder left on the sidelines to buy the next move up. But investors aren't just running down their cash, they're starting to bet with money they don't even have. Over the past 3 years, total margin debt has surged by nearly 50%, climbing to around $1.2 trillion, the highest level on record. That's usually what markets look like when investors are becoming more comfortable taking risk, and that matters when valuations are already elevated like today. The S&P 500 is currently trading around 22 times earnings, a level we last saw during the .com boom and again just before the 2022 bear market. This combination of stretched valuation and aggressive risk-taking puts the market in a fragile state, where it becomes more vulnerable to unexpected shocks. And that's why some of the most prominent investors like Howard Marks and Dalio are starting to sound cautious as we head toward 2026.